All right, welcome to another episode of Asset Coach and Tax Strategist. My name is Robert Wolf. I am an asset coach and tax strategist, and our goal for this channel, this is really just kind of give you some insight as to how different assets work, structuring of assets, and how to actually have these assets that are available to us, how they actually can lower our taxes, and that's where the tax strategist part comes into play. And so our purpose, our point is to kind of read through the guidelines, read through some of the tea leaves, if you will, and kind of give you a different guideline or a different understanding of how investing works. We have a lot of people that are very focused on certain specifics of investing, and nothing wrong with that. But for us, for me, my focus is really on to say, okay, how does the IRS communicate to us about what taxes or what assets we have that are taxed? And how do we structure them in the legal system that's available to us, not just under the IRS legal system, but the Securities Exchange investment legal system? How do we allow that to those two separate entities connected by the legal system? How are we able to do that? And so that's really what the goal for Asset Coach and Tax Strategist channel is to provide episodes that kind of talk about this. And so some of the things we'll talk about you may have heard of. Some of the things we talk about, you're like, huh, that's interesting. I haven't heard of that. And some things we talk about, you're like, you're off your rocker. Either way, totally fine. But our goal is to give you this information as really for you to help do your due diligence and figure out what's most important and right for you and your situation. And that's the key. What's right and purposeful for you and your situation. Okay. There's just so much information. There's just so much noise. There's a lot out there. And how are you supposed to, somebody who's a full-time job, husband, parent, wife, whatever you're doing in your life, busy, supposed to know all of this stuff? Right? And it's hard. It's hard. And so you make the best decisions you possibly can based on the information without going to analysis paralysis. And so today's episode, what I really wanted to do is kind of dive into more of what do the wealthy do to become wealthy? How do they navigate this system of investing, this system of taxes, to create more and more wealth in the most efficient way possible? Efficient meaning lowering taxes, meaning expenses, lowering risks, and enhancing the return on that particular decision or that asset. Okay, those are the three pillars, right? And so if you're able to do that, what's that look like? Now, what I see a lot of times is people that are very heavy in a particular area. What do I mean by that? So a lot of people come to us and like, Bob, I love real estate, blah, 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 blah. But I have a tax problem. Well, why? Because you went into real estate and this is their words, they went into real estate because it's tax efficient. Well, guess what? The IRS isn't stupid. They know how to structure these assets to where they give you tax benefits, but over a period of time, it ends up creating more taxable income, tax liability. They're not dumb. Same thing with 401ks, right? Oh, put all your money into a 401k, defer that taxes, don't pay taxes now, watch the growth deferred, but then what happens on the back end? You pay taxes. Okay. And not only do you pay taxes, what they don't focus on much is how the inflated dollars and the valuation or the devaluation of your dollar later on is, which is what's so important of you to get a greater rate of return. So actuality, they always say, well, you'll be in a lower tax bracket when you retire. Most likely not. Most likely not. Okay. So does that mean it's a bad asset? No, not at all. Especially if that's the thing you have. That's all you can do. Great. Do it. Right. That's the point, is that not making a particular decision, a particular asset, the best one. Right? They're all there. They're all tools. So I love watching construction and building and different projects, whether it's metalwork or wood or whatever, on YouTube. I love those channels. But what's very interesting about every single one of those channels is they use multiple tools in that process to create the outcome that I'm watching them build. Not just one tool. So why in the finance, why when it comes to our money, all of a sudden we think we have to have one particular tool? And that's not the case. They don't even use the same wood they use wood differently in different applications and for different reasons, different sizes of woods, different sizes of tools. to create the different outcome. Okay. So it's very important to understand that you really need to have a tool belt and to be able to go out there and build what you're building. What are you building? Financial freedom. You're not building a retirement account. You're building financial freedom. I almost guarantee you, if you had enough money right now to live the rest of your life and not have to work another day, you may just stop. And if you don't, it's because you really love and enjoy what you do. And that's not work. Okay? So financial freedom is what we're looking for. The ability to have a financial situation where you can decide on what you're going to do with your days, day in and day out, without having the consequence or the worry of money. That's financial freedom. And it's different for every person watching this. Everybody's different. But we focus on this retirement thing, which is a 20th century thing. The 1950s became this retirement thing. And all of a sudden, we had this retirement industry boom. Right? And all of a sudden, we got to work towards this period of time to stop working and accumulate all this money. Right? So, what's this all mean? Why am I talking about this? Because today's episode, we're talking about how do the wealthy get wealthy? How do they make money? And it's going to be a little contradicting to a lot of the education and advice we have. Now, here's the thing. What I'm not saying is a generalized, this fits for everybody. This is very specific. So, for example, Dave Ramsey and folks like Dave Ramsey talk about debt. And that's what today's episode is going to be about, debt. Now, debt could be a very, very bad economic term, meaning it could deteriorate your wealth, it can deteriorate your livelihood if used inappropriately. Okay? But it could also be very good and helpful. It's how you use it. So, when Dave Ramsey's talking about, in my opinion, debt, bad debt is credit cards. It's personal debt that is not building your wealth. Now, we kind of use a mortgage as an okay thing, and we pat ourselves on the back, and it's our biggest investment. It's not your investment, it's your home. It's your home. You're looking to buy it for a period of time. Now, some people buy, wait for it to appreciate, sell, and upgrade or change where they want to go. That's an investment, but it's an asset first. Okay? But right now, your mortgage, your house is a liability because you owe the mortgage. Once it's paid off, now it's yours. Okay? But it's still, to Robert Kiyosaki's point, it still can be considered a liability. Don't pay your property taxes and see what happens to your house. Pay it off or not. Right? So an asset is something that should be creating you a revenue stream or cash flow. Robert Kiyosaki says income. It should be appreciating and creating you an income. Okay? Now, I don't like the word income. I prefer the word cash flow. And here's why. Once it becomes income from a tax perspective, it becomes taxable. And depending on the type of asset, depends on the type of income, depends on the type of tax. Okay, so W-2 wages is taxed different than rental income. Okay, so we need to understand that aspect of it. Okay, so you needed to create cash flow because cash flow you can plan. So here's the saying we tell all of our members. Income is taxable, cash flow is plannable. You want cash flow. Now, it may eventually turn into income, but that's after you determine the planning. Okay, which tools are you going to use in your tool belt? Okay, so let's talk about debt, not from a credit card negative aspect, from a Dave Ramsey talking to the general public, right? Dave Ramsey's marketplace is different than my marketplace. My company, we work with high income earners, accredited investors, physicians, successful business owners, right? That's what that's what we do. So I'm trying to bring to light a different side that these are all the same rules that our members utilize that you have access to as well if you don't fall into that category. Okay, if you fall into the Dave Ramsey category, doesn't matter. You still have access to all these tools. To what level, to what decisions you make, totally different. Okay, so how do the wealthy use debt? Well, debt used to build assets like your mortgage, as we were discussing, is very similar. Using debt to be able to build asset classes is very important. So we call this the buy, borrow, die strategy. Okay. And this is really based on a company, the Fiscal Policy Institute, DC Fiscal Policy Institute. Okay, that's where this PDF came from. So I clicked on download the PDF, and here we are. Okay, so how wealthy households avoid taxes on their growing fortunes. It's not necessarily they're avoiding taxes, it's the tax code doesn't tax them on these decisions. They're making decisions. And you and I are going to say, well, you're trying, your motivations to do this. Well, if you had the opportunity to build your wealth or reduce your taxes or make more money, you would make decisions to avoid expenses, right? If I could lower my expenses, does that mean you're avoiding spending money at restaurants, avoiding entertainment? You could use that term. I think avoiding is determinant on a motivation of somebody. And if we're writing an article, we're assuming their motivation, which I think is inappropriate, but that's just my opinion. But the point is, how do the wealthy households use the tax code to help them grow their wealth, their fortune? Okay, that's what, so the US and DC tax systems include many advantages for wealth, allowing to concentrate in the hands of few households. No, concentrate in those who make decisions for their households that put them in the position to have this opportunity. It's bigger, it's a lot different. Now they're called wealthy households, can use 3 steps buy, borrow, die strategy to get massive capital gain tax advantages. This strategy protects the inheritance of wealth, especially extreme wealth, allowing the very wealthiest families to hold, live off of, and transfer that wealth without ever paying taxes on it. And it's all legal. Yes, this is how the system is designed. Everybody has access to this system. All right. So racial justice, why is this considering, why are we even talking about race when we're looking at this? We're trying to, requires unrigging the system that allows tax avoidance? No. You're missing the point. This has nothing to do with racial justice. This has everything to do with making a decision today. Some of the wealthiest people in our country today are of different colors, races, and backgrounds. So, not a big fan of this, but either or, whatever. All right, so let's dive into the point of this. Let's get out of the politics of that, and let's dive into the actual what's this point. Buy assets. That's the first thing. Buy assets. Well, how do I do that? Well, you need to make decisions to put yourself in a position to where you can get money from somebody else. Okay, that's the leverage part. That's the borrow part on step 2. Okay, but to buy assets, you can buy cash, so you can use it with your cash. So, Bob, all I have is $1,000. Awesome, buy it. But you have to do your research. Can that $1,000 grow to $2,000? If so, when and how much risk are you taking? And what's the cost of that? Not just the risk, but the expenses of that. That yields what you'll get back. And if it's appropriate to you and pleasing to you, rinse and repeat. Now, do you make other decisions? Do you decide to get a second job or work more hours or spend less money to have more money to put in this formula? Sure, that's up to you. That's a decision you can make for your benefit, not blame other people for doing this decision and you have it, and so that they're doing something different and wrong, and there's injustice. No, these are decisions that you can make. Okay. Now, when we buy certain assets, so like stocks, bonds, real estate, art, or other valuable assets, they say high value assets, but other valued assets, you can hold these assets. They can appreciate and grow in value. That's what an asset does. Now, you may not generate income from these assets. They're just appreciating. So let's use your mortgage as an example. Your house, let's say you bought your house and let's say it was $200,000. You put down your 20% and you got a loan for the other 180,000, and that's your monthly expense. And that monthly expense is fixed, isn't it? For 30 years. You know that. So as your income increases, as you make decisions and allow your income to increase, that expense doesn't increase. Now, that house could appreciate from 200,000 to 300,000. That creates equity. And as you're paying down the 180 and your house grows to 300, now you have 120 plus the pay down of the mortgage. That's your equity. You can borrow against that. And what do we do with that, Bob? Buy other assets. That's what the wealthy do. What the poor do, and what advice, and this is why Dave Ramsey says don't get into debt, is because what the poor do is they continue to make bad decisions and they use that cash and buy bad things. There's some cash value life insurance agents out there that tell people to go buy, to build up their cash value life insurance, and then to use that money to finance their own vehicle. Well, that's not an asset. That's a depreciating asset. We all know once we drive off the lot, it's been devalued. Why would I do that? Oh, so you don't give a bank interest rates? Well, what if interest rates are at 5%? Is that better than losing 30% value on that vehicle? So I buy a vehicle for 60 grand, 60 grand times, and it goes down by, let's say, 30%. That's 18,000 dropped on that 60,000. But I spent 60,000. So I owe 60,000, but my vehicle's worth 42. Is that 5% financing with the dealership better? Probably. But on the flip side, if I borrowed that same money from my policy, and I'm just using cash value life policy, and I use that as my 20% down payment, okay? So let's use that same $60,000 and I use that as 20%. That means I can buy a $300,000 property, real estate property. Same 60,000. And I can rent that. That's 20% down. 60,000 gets us 300,000. And now I can rent that out. I've already got my 60,000 equity. That's already valued. I didn't lose it. Okay. And what if that generated $100 a month of cash flow? Awesome. Now you have an extra $100 a month. Perfect. Now you can take that $100 a month and actually pay back that insurance policy in creating a promissory note between you and that new asset. And that makes that $100 a month now an expense and not income. That's what I mean by cash flow. Now we turn that cash flow into an expense, and now you have two assets appreciating and growing and no taxable income. That's the step 1 and 2. Now, step 3 is die and pass assets tax-free to heirs. What's that mean? Well, in the current estate laws, what happens is that in real estate and investing, there's something called a basis. A basis is what you put into it. So let's say your mom and dad bought their house for $200,000. That's their basis when they put that $200,000 in. 30 years later, both mom and dad pass away. That $200,000 property is now worth $1 million. They pass away still owning that house. The difference would be capital gains would be 80, that 800,000 capital gains, but they died. What the estate planning says, the heirs get a step up in basis, meaning that $1 million is now your new basis. So that whole 800,000 is tax-free, no capital gains. Okay. Versus if mom and dad didn't die, 30 years later, they sell it based on current rules and an assumption for current laws, married filing joint, you get up to 500,000 of equity, not capital gain taxed. So that means 300,000 of it would be taxed as capital gains. Versus if it was kept, they died, then sold, you get the full amount, step up basis. See what I mean there? Extremely, extremely, extremely valuable. Very, very important. That's what the wealthy do. Rinse and repeat. And what assets can you do this with? Pretty much every asset that has value. You can do it with your stock portfolio. You can do it with your life insurance portfolio. You can use it with your real estate portfolio. You can use it with your business portfolio. It's understanding these rules and rinse and repeat. The key is increasing the value of your wealth and lowering your tax liability by understanding the rules in place. These rules are for everybody. Everybody. So you need to make decisions that are appropriate for you and not blame other people for making these decisions if you don't. Well, Bob, man, that's great advice like 10 years ago. Sure, the best time to plant a tree was 10 years ago. The second best time, right now. Change. Make that decision today. Plant that tree today. Sit down and figure out, what am I going to do to make a change today? Make those little habit changes day in, day out to put yourself in a better position. So the only person you can blame is the person you're looking at in the mirror right now, or the only person you can pat on the shoulder, give a high five, knuckle bump, say you did a great job, is the person in the mirror as well. You're accountable to yourself. Cannot sit there and blame everybody else for your decisions, good or bad. Buck stops with you. What an amazing opportunity. When you have that freedom that it really relies on me, I'm the only one I'm in control of. I'm not in control of anything else but me. Whew. That's a breath of fresh air. So go do it. Go do it. There's the formula. It's laid out for you. So hopefully this was great. If you haven't subscribed, man, hit that little subscribe button, that little bell. We drop episodes every Thursday. Give us a thumbs up on this content. This was really good content. This was today's, not every day's. I don't get off a session recording and go, man, that was awesome. This was awesome. This is that I'm going to plant a tree awesome moment. Just going to say. So I deserve a thumbs up only if you do it. If you don't do it, don't subscribe. Or subscribe so you keep hearing these encouraging words to help you make that decision. Take that step forward. Wherever you're at, whether you've got $1 million of cash sitting in your bank account or $100, does not matter. The decision is yours today. Go make it a great day.